The real quick, as a quick promo, as we just went through our first fiscal and monetary policy Friday, where we hit it heavy on wage and price controls, what inflation is, and an introductory level. Next Friday will be the second ever and running series, as long as Vincenzo's Go Crypto Investing is on YouTube, Fiscal and Monetary Policy Fridays. But this is an intro. We left off when I accidentally played the music, or when I clicked off it turned on and I didn't know. Talked about balance sheets and cash flow and generating, buying and investing in assets that generate cash flow, right? And this is a quick promo. Robert Kiyosaki there. Check out his audiobook, Fake Money, Fake Teachers, Fake Assets, right? Very insightful. Knowledge is knowledge. Knowledge is power. Repetition is key. In the famous words of Robert Kiyosaki. This is a promo and a brief what we can expect tomorrow on Commodity Mondays. Our first ever really in-depth Commodity Mondays will be a running series as long as Vincenzo's Go Crypto Investing is on here. But here's what Vincenzo has done over the past couple of years. He's invested slowly but surely and has built positions now that are starting to become sizable in cash generating assets. I've shifted my portfolio into more cash generating assets, and I've taken them out of the liabilities, right, that suck the blood and life money out of you, to things like this. I am not a financial advisor, nor do I play one on my own radio show. This is strictly educational and entertainment. I cannot recommend stocks, commodities, mutual funds, etc. This is just my own personal opinion and beliefs, and what I do and what I have done over the last 12 to 18 months is I've invested in the Euro Pacific Gold Fund A. And I've just added $2,500 more to that position. And now they've upped their dividends from last year. I received 8.25% last year in a dividend from this, which means I made money regardless if the stock went up or down. They pay you just to be part owner of the company, and that's what you are when you own shares. And now they've upped that dividend by 1.25% to 9.52% yearly dividend. That means whatever your cash value is, whether this stock goes up or down, you will be paid on that average that you've had for the year, 9.52%. To try to get that in the criminal gangster cartel central banks, it would take you 100 years, actually 900 or 1900 years to get 9.52% interest on your money. That is what in the balance sheet, which if you want to be rich, you must have, is called the asset part of your balance sheet. You guys are familiar with the liability part and the after-tax income part of your balance sheet. You need the cash flow part of your balance sheet, known as the assets. What assets do you have? What assets pay you money while you sleep? What assets work for you instead of you going out at your normal job, which is when you're an employee at a job, you pay the most taxes at the highest rate with the least amount of deductions in the system, but you have to physically be there and put the hours in to generate money. The rich people have cash. When you know what money really is in an education on money, their money works for them. We and you guys, Vincenzo is weaning off of the we and becoming part of the rich, is our money works for us. We don't work for money. Our money works. Yes, our money works for us, right? And that's what we're going to get in on Fiscal and Monetary Policy Fridays too, also on Commodity Mondays. And something we're going to talk that you guys, and this is a breaking news alert, exclusive to Vincenzo's Go Crypto Investing. He's going to bring up U.S. government 10-year bonds, right? I bring up bonds. I bring up M2 money supply. I bring up the Fed balance sheet, right? Exclusively to Vincenzo's Go Crypto Investing. None of these other crypto sites, from 1 subscriber to 1 million, Crypto Carl, Crypto Crow, Carl from the Moon, all these scumbags, they don't talk about this. And yes, right here, real quick, you can see we have a falling channel. And you say, well, how the fuck do I know if it's a channel or a wedge? Well, a channel, you see that right here, is the same width at the beginning of the wedge, or the channel, and the bottom of the channel. A wedge of a rising wedge or a falling wedge with our industry exclusive drawing tool would look like that. It's wider at one end and narrower at the end, right? These are usually the same, but yes, these are usually bullish, and they can be bullish and bearish. When they're angled up, it usually signifies the buyers are being exhausted, and the sellers or the bears are taking over the market, and the price is going to come down. And the price, in that case, if the wedge was rising, or the channel was rising, would be the bottom of the channel. Now, in this case, usually in a probability based, and these are all been manipulated by the central banksters and the criminal gangsters and hustlers and fleecers in Washington and in the central banks around the world, in the European Union, Australia, Bank of England, all those scumbags, the Federal Reserve banks and the local federal bank of your country have been driving down interest rates so they can pump in phony inflation and stimulus and all that other shit, which is inflation. But they can only do that if long-term bond prices stay suppressed so they can pump off fake money and try to hold down inflation, right? If they keep pumping this phony inflation into the economy like Joe Biden's $5.5 trillion of inflation that he's printed this year already, if these interest rates skyrocketed, it'd be over. Let alone fucking 16% 10-year bond. You remember that? That's how you used to get money in the bank. Back in 1980, you were getting 15 to 16% in interest in the bank. Or not that much, but you're probably getting 8% in the bank, 16% on a 10-year treasury. Well, they've had to force that and manipulate it down. Now you're just above zero. We were having some kind of problem when you just had, see that little spike right now? Yeah, I know you can't notice that, but that was causing problems. And yes, this is a descending channel, and those usually are signifying the sellers or the bears are being exhausted, and the bulls or the buyers are taking over the market, and the price, in this case, the bond yield is going to go up. And the price, if you can break out of here, is where this channel started, which is way up there. 10% would cause, long before you got there, the whole United States and world economy would collapse, and you would have a 1920 style global Great Depression, right? Long about here would already have crippling depression in the United States and starting to spread around the world. The United States would default. They wouldn't be able to make their payments to foreign companies that have loaned them and their foreign counter trade partners like China and all these other countries where we get consumer goods and products and raw materials, and they ship us goods and we give them dollars and IOUs because we don't produce anything. Let's zoom in now. Oh, we need to zoom out. Let's say right here, you can see all we essentially did is after the COVID dump in interest rates, long-term bond yields almost to zero when they were trying to stimulate the economy. Now it's starting to come back up, and this is already causing a major, major problem. And what I think is going on here is this is old support and resistance, and that could become valuable at a later date when you just extend them out into the future, right? But here's what I think you got going on here. If we pull out our trend line, right? We got upper resistance. You see what's going on already, don't you? We're going to clone this. You got lower support, right? We're going to make that bigger because these are the ones that are in play. We're going to make them yellow to make them easier to see. Sign. You can kind of see what we got. We look like we got a bullish consolidation, and it would be a bull pennant, the opposite of what we see in crypto. And you'd go from the bottom of the pole to the top of the pennant or flag, and then you bring it to a point of a breakout. And this is major 40-year overhead resistance, this line. We're going to make this red because this is the danger line for the economy. This has been suppressed and has been major, major, major overhead resistance, that downtrending red line, since 1980. So if you break this, the sky's the limit because you're printing money and causing inflation at a mass level while simultaneously limiting the productive capacity of the world, and especially in the United States, that this is going to explode, and Vincenzo expects this to explode. This all ties into what we were talking about, oil prices and dollar devaluation, And when central governments and banks print money, which is inflation, and because inflation is expanding the money supply, and the effect of that is higher commodity prices, oil, consumer goods, food, refrigerators, energy, gas, stuff like that, homes, asset inflation, right? But also what comes with that is with the inflation is long-term interest rates skyrocket, and debt now that you've acquired at a cheap interest rate that you thought you could afford because the interest rate was cheap, so you based it on cheap interest payments versus the size of the debt, when it's always the size of the debt that matters, not the interest payments, right? That's what Vincenzo believes, and that's what you should believe, because that's what Austrians believe, and Keynesians believe it's the size of the interest rate and payment, not the size of the debt. And that's why we're in this fucking mess that we're in right now around the world and in the United States. And I believe there's nothing the federal government can do. Jerome Powell, the Fed chairman, Janet Yellen, the Secretary of Treasury, or Joe Biden for that matter. None of them want to do the right thing. None of them will do the right thing. It's all about kicking the can, in the words of Peter Schiff, down the road, and trying to get elected and make it somebody else's problem when you leave office. Well, the only way to stop this massive inflation that you're seeing in used cars, consumer goods, and all that is to raise interest rates. And you say, well, good, raise interest rates. The economy's great. You can't raise interest rates because we're so heavily in debt that if this even goes from right here to right here was already a major problem. Now, if this breaks up in the next weeks to months and you end up here floating at 3%, you're going to be in a catastrophic recession, deflationary depression, which means you have no jobs, you have skyrocketing prices, while at the same time your income is going down, right? And then you have product shortages, food shortages, wage and price controls that I talk about. This is a disaster in the making, and communist printing press Joe Biden that literally prints inflation from the time he comes up in the morning till the time he wakes up the next day. He's one big massive inflation machine, and it's going to end horribly wrong. And I expect in the next weeks to months, U.S. government bonds to be flirting by the end of 2020, or by the mid to end of 2022. I expect long-term U.S. government 10-year bonds to be pushing 3%. I expect oil to be pushing $150 to $200 a barrel. I expect gold to be flirting with $3,000, $5 to $10 a barrel gallon of gas, and massive inflation to continue. And these product shortages are not transitory like Jerome Powell says. They are going to be the new normal. This is not transitory inflation. This is the new normal in inflation. And expect an annual for the next 5 to 10 years, 5 to as high as 10% year over year inflation. Like, subscribe, and share Commodity Mondays tomorrow.